It's easy to get caught up in the headlines about defense stocks. But today, we're going to look past that, at the much bigger prize, the massive multi-trillion-dollar opportunity that comes after the conflict. We're talking about the Reconstruction Supercycle. And believe me, it's all about rebuilding, not just defending.
All right, let's just cut right to the chase here. The moment there's trouble, the market piles into defense stocks. It's almost a reflex. But what if that's the wrong play? What if the real, long-term wealth isn't made during the conflict, but in the guaranteed, multi-trillion-dollar rebuilding that has to happen afterwards? That is the core idea we are unpacking today.
So, here's our game plan. First, we're going to bust the myth of the typical war trade. Then, we'll dive headfirst into the Reconstruction Supercycle thesis itself and identify the key picks and shovels. And we're not going to gloss over the risks either. We'll cover the sovereign debt trap and the political minefield. Finally, we'll bring it all together and look at why 2026 is shaping up to be such a pivotal year.
Okay, let's get into it. We're going to start with the story you always hear, the most common investment narrative during times of conflict. But as you're about to see, it's a story that's really built on some pretty shaky ground.
You've heard the old saying, right? That cynical idea that war is somehow good for business. All that government spending, all that production, it must be a net positive for the economy, right? Well, the actual data, the hard numbers, they tell a very, very different story. So let's dig in.
And here's a fact that just blows that myth right out of the water. A huge study by the European Bank for Reconstruction and Development looked at over 100 wars and found this incredibly consistent pattern. When a country becomes the battlefield, its per-person economic output absolutely plummets. That war-fueled boom, it's a total myth for the people on the ground.
And here's why that happens. It's just this brutal domino effect of economic devastation. The actual physical capital, factories, farms, roads, it gets destroyed. Money flees the country because nobody wants to invest in that kind of uncertainty. Trade routes get cut off. And on top of all that, the government racks up an insane amount of debt, creating a financial hangover that can last for decades.
But wait, you're probably thinking, what about the US stock market? It always bounces back, right? And yeah, that's true. The S&P 500 is incredibly resilient. On average, it recovers from these shocks in about 41 days. But here's the crucial point. A resilient market that's far away from the fighting doesn't mean war is good for the global economy. In fact, that quick recovery hides the real alpha. While the overall market snaps back fast, the data shows that the industrial companies involved in the reconstruction can outperform for the next 5 years. The short-term trade is definitely not the smart trade.
So if that conventional war trade is a myth, then where is the real opportunity? This is where we pivot. This is our core thesis, the Reconstruction Supercycle.
Remember that damage to a country's capital stock we just talked about? Well, it's not just a little dip in the numbers. It's the complete erasure of a country's economic engine. We're talking roads, ports, factories, and especially the power grids. Just gone. A modern economy simply cannot function without them. And this massive, devastating problem creates an even bigger opportunity.
And this is it. This is the Reconstruction Supercycle. It's the simple, inevitable truth that after destruction comes rebuilding. It's not a short-term blip. It's a long-term trend, a supercycle, driven by enormous investments in foundational infrastructure. It's literally about bringing a whole society back online.
This quote just nails it perfectly. Think about it. What is the very first thing you have to rebuild after a war? The power grid. Without it, absolutely nothing else works. No hospitals, no factories, no data centers, nothing. It is the ultimate non-negotiable. And that means the companies that build and transport that electricity are completely indispensable.
Okay, so this all sounds great in theory, but how do you actually invest in it? Let's get practical now and identify the picks and shovels of this new, modern Marshall Plan.
Let's just be crystal clear on this. There are 2 phases. The destruction phase is all about weapons manufacturers. It's short-term, it's cyclical. But the reconstruction phase, that's about the industrial and engineering firms that literally rebuild a country. That's a long-term, foundational investment.
Let's break this down. It's exactly like the AI boom, right? The really smart money wasn't just in the AI software companies, it was in the picks and shovels. The companies like NVIDIA making the chips. It's the same logic here. Number 1, you need the power infrastructure itself. That's the bedrock. Number 2, you have the EPC firms. That stands for engineering, procurement, and construction. These are the master contractors, the ones who manage these gigantic, complex projects from the blueprints all the way to the final build.
They are the boots on the ground. And number 3, you have the essential support companies. A modern rebuild includes things like data centers, which need incredibly sophisticated thermal management and robust networking. These are the high-tech, often high-margin components of any 21st century rebuild.
Okay, but before we get too carried away, we have to talk about the risks, because this is not a sure thing, not by a long shot. And the first major hurdle is a simple one. Who's actually footing the bill?
This number, well, it's just staggering. During a war, a nation's debt compared to its entire economic output jumps by an average of 47%. So they come out of a conflict not just physically broken, but financially crippled. How on earth can they possibly afford to rebuild?
And here's the really harsh reality of it. The United States, as Warren Buffett likes to point out, can always print more money to pay its debts. But a war-torn nation can't do that. Their currency is fragile. They have to rely on foreign loans or raise taxes on a population that's already devastated. Both of those options dramatically increase the risk of a sovereign default.
And this is the brutal truth of the whole thing. You can back the best engineering firm in the world with a guaranteed government contract, but if the government paying them goes bankrupt and defaults on its debt, your investment is suddenly worthless. Your brilliant growth play just became a default gamble. And yeah, there's something called political risk insurance, but it's really expensive and often has more loopholes than actual coverage. That's why checking a nation's debt-to-GDP ratio and the stability of its foreign backers is absolutely non-negotiable.
All right, so that's the financial risk. The second major risk is, well, it's a lot harder to put on a spreadsheet. It's politics. The financials can look solid, but the political landscape can shift overnight, and your investment can shift right along with it.
So what is political risk? Really, it's the danger that a government's actions will completely tank your investment. Think about trying to navigate the EU's Ukraine investment framework. The money's there, sure, but it comes with this complex web of political conditions that can change with every single election cycle. Or imagine a place like Gaza, where reconstruction funds might be managed by a board of peace, an entity whose leadership and priorities could be completely overhauled without any warning. A peace treaty is just a piece of paper. The political will to uphold it and the stability of the people managing the money, that's everything.
And it's not just about new conflicts breaking out. Even in what we'd call stable democracies, politics is a huge factor. Think about it like the red team versus the blue team. One administration signs a multi-billion-dollar infrastructure deal. The next administration comes in, calls it a wasteful project, and cancels all the contracts. These are long-term projects, and they require long-term political stability, which is, never a guarantee.
So, we've covered the core thesis, the key players, and the really profound risks. Now let's bring it all home to the timeline. Why are we so focused on the year 2026?
Well, 2026 is shaping up to be this crucial convergence point. First, you've got the AI boom, which will be in full swing, demanding an unprecedented amount of power and data infrastructure, the very things that are the cornerstones of a modern rebuild. Second, a nearly $2 trillion wall of commercial real estate debt is set to mature. This is going to force a massive reallocation of capital away from old-world assets. Investors are going to be desperately looking for the next big long-term growth story. And that's where the third point comes in. As today's major conflicts hopefully find resolution around that time, capital is going to pivot. It will flow away from the short-term destruction trade and flood into the tangible multi-decade reconstruction supercycle. The need will be there, and for the first time in years, the capital will be there too.
And so we end with this question. The market is always looking forward. By the time peace is announced on the front pages of the news, the big money will have already made its move. The real opportunity isn't in reacting to the news, it's in anticipating the next great economic cycle. So the question for you is, will your portfolio be positioned for the immense, multi-year task of rebuilding, or will it be stuck holding the assets that were designed for the conflict that just ended?